What is going on? We are finally to the fun part of the bootcamp. So this is where I'm going to introduce the term liquidity. Okay, let me just write that down on the screen so you can understand this. So you obviously know what the word liquid means. Liquid just means like how much money you actually have available to spend, buy whatever you want to do with it. It's like liquid. Okay, that's not the same as liquidity. Okay, liquidity is a technical term related to the charts. So you need to make sure you're keeping in the back of your mind. Make sure you understand, like, I am talking about liquidity in terms of stop loss orders. So go, if you need to review, go back to the video where I did the stop loss orders, or the orders, types of orders, and pay attention to what a stop loss is, because the market will target retail trader stop losses. Okay, that is how the market moves. And basically their stop losses are liquidity. So what actually is liquidity? It's literally every high and low you see. So it's this high, it's this high, it's this low. And like I said, if you turn on a indicator that it's called support and resistance, it usually marks out all these highs. Okay, now a lot of people, they see this as support and resistance. We, as smart people, see this as liquidity, because we now know that, okay, if retail traders see something like this as resistance and they think we're going to reject it, we see it as liquidity. We want to see something like this happen where we go above it and then back below it. And that's why it's important to understand the term liquidity. So the basic understanding of what liquidity is it's basically just every single high and low you see in the market. Every single high and low. Okay. It's not just random highs, it's every single high and low you see. Right? Why do we need to understand liquidity? Okay. Because it's how you're going to enter positions, it's how you're going to find reversals. You need to find and look for liquidity, because that's where the market targets. The market targets liquidity, like these highs and lows, and it targets inefficiencies, which I'll go over in the next video. Okay, but you need to understand that every single high and low you see in the market is liquidity. It's a form of liquidity, and that's where people place their stop losses. Anywhere where people place their stop losses is liquidity, which is basically every high and low. Now, what you're going to notice is, let's say there's 10 people who place their stop loss here, and there's 20 people who place their stop loss here, and let's say there's 50 people who place their stop loss here. Okay. Now, this is where the 50 people place their stop loss at this black line. Let me just draw it out for you. And this is where 20 people place their stop loss, and this is where 10 people place their stop losses. If the market is truly trying to target stop losses, which you will learn based off of screen time and experience, then where would the market likely to go? Would it go up to the 10 and then the 20 stop losses, or would it go down to the 50? It's going to likely go down to the 50, because that's where the most stop losses rest at that very moment. Now, there's no magical tool that tells you, oh, there's 50 people who put their stop loss here and 10 and 20 here. The closest you're going to get to that is probably Bookmap, but I would not recommend using that because we use raw data. Okay, so wherever the most stop losses is, that's where the market's likely to go. And based off of time, based off of fair value gaps, based off of price action, we figure out where the market's going to go based off momentum, like I said, based off time, based off of fair value gaps. And that's what I'm going to be teaching you. I'm going to teach you how to know that, okay, we're going to go to this 50 or we're going to go to this low, because in reality, you're not going to see a number there. There's no numbers telling us how many stop loss there. I'm going to teach you how we know we're going to go to a low like this instead of a high like this. Okay, which again, keep in mind, this is liquidity. Okay, because it's a low. So there's two types of liquidity. Okay, there's buy side liquidity and sell side liquidity. So this would be buy side liquidity because it's on the buy side. All right. So this is buy side liquidity, and this is sell side liquidity. So this is considered sell side, this is considered buy side. Now, the market hasn't hit any of these, so that's why they are liquidity. The second the market goes and hits, let me just play this out. The second the market goes and hits this, delete this low. This is not liquidity anymore. Why? Because if this low is already ran, then everyone stopped out there. This is the new liquidity pool right here. So this would be the new sell side liquidity. So just remember, like after sell side's been ran, it's not like support and resistance where it's just going to stay in your screen. Okay, you have to delete it because think about it. If there's a bunch of orders sitting at this low and they all get stopped out, do you really think there's going to be more orders sitting in that low after it's ran? No, because they're all stopped out, and that's just what it is. So delete that line. The new liquidity would be right here. Okay, so that's really important to understand. Now, another thing you have to understand is there's going to be multiple buy sides and multiple sell sides. So like this is going to be buy side, this is going to be sell side. And our job, and this is all liquidity, keep in mind all these highs and lows are liquidity. Our job is to figure out which liquidity pool the market is likely to go to based off of entry points, based off of fair value gaps, based on what I'm going to teach in the next video. But you need to understand liquidity as a whole before we can figure out where the market's likely to head. So in this example here, if I just go back in time, I want you to kind of notice some observations you see. Okay, just note some observations you see when we hit sell side. We reverse. Okay, why do you think that is? Because people or retail traders, they see us going below this low as a market structure shift. Remember, I went over market structure trends, and remember what a market structure trend looks like. Remember what a reversal looks like. All it is when we make a high, higher low, and then break the higher low. So people see this as a shift, and they see it as an opportunity to, oh, I think we just broke structure. I'm going to short here. I'm going to try to get in because I think we're going lower. And meanwhile, everyone who's bullish here, okay, is trying to long. And what happens is all these orders and all these people generating liquidity here, trying to make more money on the break, are all going to get wrecked. And again, I've explained this in a few different videos already, but people shorting or who are trying to breakout trade are going to get wrecked here. And also the people who have a stop loss order under this low are also going to get wrecked here. So there's two sides of people getting wrecked here. And the third side is the people who buy under this low because they see, oh, we just knifed. There's a bunch of red candles. We hit sell side liquidity. We're inside of a nice area to bounce from the left. So I'm going to actually buy here. And that's what the books aren't going to teach you. Okay, because that's how the market moves, and that's what I'm going to be teaching you guys. So the whole point of liquidity is our job is to figure out which sell side or buy side we're going to go to first. And there's a lot of ways we can do that, but that's going to be basically the whole content of what this bootcamp is. A lot of people think ICT and what I'm going to teach is all going to be based off of fair value gaps. That is not the case. It's all based off liquidity. You should be thinking in terms of liquidity. Most people who I see fail are thinking in terms of fair value gaps. Who be like, oh, this fair value gap, full port it, whatever. Okay, and by the way, for anyone who doesn't know what full port means, because people have asked me that before, it just means going all in one position with your full account. Never do that. Do not do that. And just if I ever say that, it's usually probably a joke. Okay, so our job and your job, if you want to be profitable, is we have to get good enough or get enough screen time where we can figure out based off of price action, based off a trend, where the market is likely to head to sell side or buy side. Okay, and that's our main goal we're trying to do. So there's sell side liquidity, which is always going to be at the lows, and there's buy side liquidity, which is always going to be the highs. And to recap, if we ever do hit sell side, take the cipher chart. It does not matter anymore. Move it down to the next low because there's going to be new orders here. So this is just a little introduction to what liquidity is. Now, the best forms of, or my favorite forms of liquidity are lines that you can see very far away from your screen. Like if you're standing 10 feet away from your screen and it looks like a double top or a double bottom. So you need to, and this is why I taught retail patterns, because you need to understand what a double top and double bottom is. So if I just pull up a double top and a double bottom on Google, it's very easily searchable. We know from my other video that a double top is basically when we get one top and then two tops and then we reject. Okay, it's the same in every single picture. We get a top here, and we just reject. And often people, what they do is they short that double top. So our job is to, or the best form of liquidity is to find those double tops. Well, why do we find those double tops? Because every single retail trader, they think these double tops are like, oh, we're going to dump 1,000,000 points out there. When in reality, these double tops do not work that well. And what we're going to end up doing is we're going to run all the way back. And look, this picture proves my point. Look where it says I put the stop loss. Right here. See how it says put the stop loss above this double top? That's exactly what the books teach. And that's why we target double tops, because that's where the market moves to. And you're probably like, oh, that's BS. I've used double tops a ton. Yeah, maybe you have. But I'm the guy who trades. I'm the guy who longs and then sells in the pump back to the double top and probably made 5 times your income in 2 weeks. Okay, so just know that. I'm not trying to brag or anything, but just know that double tops are not going to cut it. You're going to get wrecked because we will run through a double top. So a really good example was this morning. Okay, so this morning in NQ, we get a very, very clean double top. Okay, it was on this 1 minute chart. Okay, now I want you to notice something. So this is NQ. This is what I trade. There's 18,000. It's at 18,541. Now think about it. That's a really big number. So what happened this morning was, if we zoom in on the 1 minute time frame, okay, look at this. You can see these equal highs here. So see how these highs, right? If I just zoom in a lot, look at this. So this high at 5:37 a.m. and this high at 5:38 a.m., okay, are equal highs. They're right next to each other. And you can see the high in the top left. You can see the high in the top left of this candle was 18,542. The high of this candle was also 18,542. So why is this significant? Well, later in the day, what ended up happening was we made another high at 18,542. See that? Now, how rare do you think it is to form a high on an 18,541 price, right? That's a really big price. How rare do you think that is? Pretty rare. And that means something. How many people do you think see, oh, we rejected the same level 50 times? Look, 1 rejection here, 2 rejection here, 3 rejection here, 4 rejection here. How many people do you think see that and think, oh my God, we've rejected it 3 times? It's major resistance. And what they do is they short it. Basically, they're like, oh, this is resistance. We're going to reject. And look, this is exactly what I'm talking about. Let's go. My short's winning. My short's winning. I'm along here. Boom. Wrecked. We just run back right to these equal highs, and we just look at the momentum that we pick up to go back to the equal highs. Now, look at the momentum we get off the double top right here. See how this is a double top? See how the market really, really slows down and really consolidates here? Options are going to get wrecked there. And then look, the momentum going back above really, really tells you why the market works the way it does. Why do you think we get momentum way back up with almost no red candles and not good momentum back down? It's because so many people are shorting this double top, and they don't want retail traders to win because they know where their stop loss is placed. Okay, where is the algorithm going to target? The algorithm is going to target above this resistance line because it knows there's going to be last stop losses there. And here's the science behind why the market targets stop losses, okay? Why do you think that is? Like I said, in order to get in a position on the DOM or whatever you're trading, for every seller, there's a buyer, and you need that contract. You need an opposite contract in order to get filled. So like I said, if you're trying to buy at 18,001, if you're trying to buy at 18,002, there must be people willing to sell here. There has to be, because if there's not, you're not going to get filled. So you must find a seller at this level. Now, what if there's sellers here and here, but not at here? Well, then you're not going to get filled. So the importance of why the market targets stop losses is because there's a stop loss. Think about it. When I went over the orders video, okay, remember the orders video, I basically told you guys, I'm like, if I'm taking a short right here, okay, if I'm taking, let me just go back in time. If I'm taking a short right here because I think it's a double top, okay, this is just get in the mind of a retail trader. I'm taking a short here, I think it's a double top. think about it. In order to get out, we need to place a stop loss. Now, a stop loss is, all a stop loss is me buying back. Okay, I am buying back the position. I'm buying another contract. So my stop gets hit here. How do I actually get out of the position? I have to buy. And it's just like buying. It's just like if I go in the market and buy Apple. Okay? Like, it's just like if I were to go in the market right now and I were to buy Apple stock. In order to get out of a short position, I'd need to buy a contract because else I won't be able to get out. So I buy and think about it. If I had to buy right here to get out, that forces me, or that forces people to buy up here, which means which means the people trying to sell here are going to get filled, because all the people trying to sell above this resistance line need buyers to get filled. Because like I said, if there's no buyers, the buyers are down here, how the seller is going to get filled? So this represents people's stop losses, because they think, oh, if the market goes to 18,001, 18,002, which obviously would be 18,043 or whatever, but if the people actually want to get out, okay, they're going to place a stop loss there because they think, oh, if we break this resistance, we're going to go up, because that's what retail traders think. That's what the books think, okay? You need to understand that perspective. So, like I said, there's people that are going to be placing their stop loss above there. In order for me to get out of the position, if I did place my stop up there, I have to buy back the position, okay? And if I'm buying back the position, someone has to sell my contract. If I'm buying back, someone has to sell it, because for every seller, there's a buyer. So the market's targeting these stop losses because it knows that everyone putting their stop loss here is going to generate a bunch of orders. There's going to be 500-600 orders sitting up there, all stop losses. And that is liquidity. All these orders resting up here of stop losses who think, oh, if we go above this, I'm going to get stopped out. There's a bunch of buy orders sitting up here. And if the market wants to reverse, it needs that liquidity. It needs those buyers to buy back the position so sellers or smart money can sell up here. Because like I said, if there was no stop losses up here, there's no orders. And how are sellers supposed to get in if there's no orders sitting up here? So that is the science of why market targets stop losses, because in order to reverse, we need liquidity, and the market knows there's a bunch of orders up there, and for every single seller, there's a buyer. And it needs those sellers and it needs those buyers up above here, and if we want to reverse or go the other way. That's why a lot of times when you see a double top, there's not going to be as many orders here as you think, because no one's getting stopped out. So there's not a bunch of orders here. There's not a bunch of stop outs here. And that's why the market doesn't accelerate here, because there's not enough orders. And that's why when you see momentum going up to this resistance, it's much more momentum, because there's going to be a lot more orders of, okay, there's a bunch of orders up here. These guys are going to get stopped out, and that's when the market will pick up. Okay. Excuse me. Bless me. I'm sorry. I'm not editing these videos, so if you type in "bless you" in the comments, that'll tell me who got to the 18-minute mark. And I doubt barely anyone did. So what's interesting about this bootcamp is this is going to be my 15th episode. And in the beginning of the bootcamp, I basically said, I'm like, I bet you 20% of the people who watch that first video are going to be at the end of the bootcamp. This is only the 15th video, okay? There's going to be like probably 35 more, if I had to guess. But if you did make it this far, just comment the word "bless you." We'll see how many people actually made it this far. And what I just said was a very good explanation. You will not find a better explanation than what I just explained. So you might have to watch it a few times, but the gist of what I just said is, for every seller, there must be a buyer. And like I said, if there's no stop losses here, there's no buyers, which means how can people sell above this resistance if there's no buyers here? You can't. Okay, so that's like the most simplest explanation I can think of. And yeah, so that's why the market targets stop losses. And again, this resistance line is liquidity. This is just liquidity. Okay, and now pause the video. What would this be, buy side or would this be sell side? I'll give you 1 second. Okay, so if you pause the video and you said buy side, you're correct because it's at the highs. Every single buy side liquidity is going to be at the highs. All the sell side liquidity is going to be at the lows. And remember, you have to realize that, I don't want to confuse anyone, but like technically speaking, like this is sell side liquidity. This is sell side liquidity. This is sell side liquidity. This low right here. I mean, this isn't a swing low, but it's probably a swing low in the lower time frame. Like this is sell side liquidity. Every single low is sell side liquidity. Now, remember, if I were a retail trader, you have to realize how many stop losses do you think are going to be below this low? Probably not a lot. Probably, let's say 10. Do you think it's going to increase or decrease at this low? Now, the answer is going to be increase because this low is much more obvious. You can very clearly see it. A lot more retail traders are going to think this is support. So therefore, the stop losses would probably be a lot there. Same thing with these. There's probably even more stop losses here because, again, I don't want to get too scientific here, but look at so this is the reaction from this level. Now, look how far this level specifically made the market move. This level here made the market move the farthest out of this low and out of this low. So this low made the market move just a little bit. So there's probably not a bunch of stop losses there because why? Well, there's probably not enough orders here that create all those stop losses. There's probably just too little orders here to create a million stop losses. And then this is in the middle. This one causes the market to go up pretty high compared to this one. So there's probably a good amount of stop losses here if I had to guess. But this one causes the market to go up, let's see, 9.8, about 40 points. This causes it to go up about 30, 25 points. This only causes it up to go up about 10 points because, again, look at this low. It's 18,533. And this high is 18,542. So, therefore, we can conclude the most amount of stop losses are probably going to be at this low. And when we do get momentum back down, or when the market does show us some reversal pattern that I'll teach you in later videos, we can expect this low to be ran because this probably has the most stop losses. Okay, and I'm going to later teach what the best forms of liquidity is. You've already kind of got a taste of that. The best forms of liquidity will be the liquidity pools or the support and resistance lines that look like they're like double tops, double bottoms. So this would be one, this would be one. This would not be one because does this look like a double bottom? No, it just doesn't. This would be a very big one because look, this looks like a double top. So again, this would be a really, really good one. And again, you might need to go back in the video to learn about why is it so important? Well, this generates liquidity. What's liquidity? All liquidity is where a bunch of orders are placed. And I explained already why there's a bunch of orders up here. So go back in the video and you need to understand that if you want to make it any further in this boot camp, okay? So that's what liquidity is. At the highs is buy side, at the lows is sell side. And the more the market moves us, the more the low moves us, or moves the market, sorry. Stumble some of my words a little bit here. The more stop losses they're going to be on the low. But remember, a double bottom or something that looks like a double bottom is probably going to have generally the most stop losses, meaning it's probably going to be targeted the most. So let's look at a few more examples of something that would be considered double top or double bottom. All right. Let me see if I can find a few examples. So like this would be a good example. So right here, we have equal lows. Right here, one. You can kind of see 1, 2, 3. So this, to me, would be considered a really good double bottom. Now, most retail traders, they're going to put their stop loss under these lows. So they're going to have their stop loss right here. Well, go figure. The market just hits their stop loss and bounces. Why does that happen? Well, I've already explained it. It's because all the stop loss right here are all sell orders. So remember, this is a buy order, right? Let's say I'm taking a buy here. It's a blue line, and I place a limit. This is my limit order. And I place my stop loss right here because I think, oh, if we go under these lines, we're going to dump way further. Okay. Now, what is my stop loss? Well, my stop loss is a short order. It's a limit order to short the market if it hits. And it's basically just me getting out of the contract that I already bought. So if people want to get in or smart money wants to buy, how is smart money going to buy the market? They need people shorting because for every seller, there's a buyer. So if there's no one shorting, how are they going to be able to get in their position? And that's why we bounce from on the slow, because there's so many people trying to like stopping out here and they're all sell orders. And that is allowing the smart people to buy their orders, and then the market reverses. And then all the retail traders get mad and they're like, oh, I was right, but I got stopped out, because the books, they teach people to put their stop losses under these lows. Okay, so you have to understand that. So that's a little taste of what liquidity is. This would be an example of sell side liquidity because it's the lows. And remember, every single high and low is liquidity. This is liquidity. This is liquidity. This is liquidity. Now let me just do a little quiz. Okay. This is liquidity. This is liquidity. Everything's liquidity. Now I'm just gonna rank these in order to so you understand. Like let's see. Like this is liquidity. So I'm just gonna rank these just so you understand kind of the best liquidity pools, and then we'll say this is liquidity. This line right here. So in this example, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 black lines. So my first question is, what should we delete off our chart that's really technically not liquidity? Okay. And I'm gonna go to here. So what should we technically delete off our chart that's technically not liquidity anymore? And what I'm trying to get at is it's not liquidity because the orders have already been ran. So take a second, pause the video. All right, so the answer, what should be deleted off your chart is this line here, 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 and this line here. So there's only 3 remaining. Well, why are these remaining? Because none of these this low here hasn't been ran, this low hasn't been ran, this high has also not been ran, right? The candle's not over it, so we didn't trigger any orders there. All right, so if I go back, all right, now that you understand that these should be deleted off your chart, what ones would I probably actually draw in live time? Or let me rephrase that. Which ones would I not draw in live time? Like what lines here would not make sense to draw in live time? Take a second, pause the video, see if you can answer. Okay, if you pause the video, the answer would be this one here, and it's probably about it. Okay, why those two? Well, those two are they're not swing lows. So you have to know what a swing low is. Remember, I already did a video on that. It's a low, lower low, and a higher low. Here, there's only higher low, higher low, higher low, higher low. So this just isn't a swing low. And yes, it is technically liquidity, but do you think there's more stop losses under here, which is something that's not a swing low? Or do you think there's more stop loss under here? Well, if I go back to a recap of what market structure is, remember, we know market structure, something like this. And people are going to place their stop losses below the lows, below this low, below this low, below this low. And the thing they have all in common is they're all swing lows. So, that being said, is this really a pivot point? Like, is this a pivot like this is? No, it's not. It's not a swing low. So I just wouldn't draw it. Same thing with something like this. Now, would I truly draw all these in live time? Probably not. I think the biggest ones here are definitely just this one here and this one here. Now, this is an interesting scenario. So, see how this is liquidity here, but this is liquidity here? Okay. I would probably only keep this drawn because this looks much more major to me. Because, like I said, we know how stop losses work. Basically, stop losses work in a way where if people's stop losses are above this high, meaning they'd have to buy back their position to get out, that causes the market to go up. So if I know stop losses here, it's going to create enough force to automatically go to this next high because even more stop losses are here. So knowing that, I just would kind of just leave this high here, because if we break this high, we should go to this high anyways, knowing how the market works and how stop losses work. Because like I said, there's going to be buyers here because they're going to get stopped out, and it's going to cause the market to fully go full force into this, because this is where more stop losses are, and that's what the market targets. So I'd probably only have this one drawn. Okay. Probably want to draw this one. I would probably draw this one. And I take that back. I'd draw these. Again, why these? Because this is like the double bottom. And this is going to be much more important than all these lows and highs in between here, because these are not going to be as good liquidity pools as something like this. Remember, this is, and relatively speaking, this can have 100 stop losses. All these other mini lows are probably going to have 10, 10, 10, 10. They're probably not going to be as significant. This is the big one. This is what retail traders, this is what the books teach. Okay. And we want to fade what the books teach. So just remember and just kind of think about that visually. Now, I probably would have this one drawn this high, because look, it matches up perfectly with a high here, here, and here. So this is like a triple top. So I probably would have this drawn. Okay, and remember, I'm not going to put a sloppy line right here. This is sloppy. We want to be precise. We want to put it at the exact high where the highest high of the triple top. This is where the market should go. Not just this random line that's in between all these wicks that don't even line up. It's perfect. This is precision. This is the first taste of precision you've probably ever seen too, if this is your first time watching. Like, draw it at the highest high, because it will hit, because there's stop losses above every single one of these highs. Look at the candle break. Like, this is just all stop losses. This is people buying back their position because they're like, oh crap, like, we're going up here because we broke the triple top. Okay. And like I said, those are kind of the key liquidity points. And then this one, obviously, because this one looks pretty major. But again, this is only part one. I'm going to be going over another liquidity video, okay, later. But this is, you need to understand kind of the concept of liquidity in order to understand fair value gaps. All right, and this is going to be the video that should definitely help you. Remember, this is sell side, this is sell side, this is buy side, this is buy side, this is buy side. You're never going to have buy side liquidity at a low, and you're never going to have sell side liquidity at a high. That doesn't make any sense. Okay, it's always going to be sell side at every single low you see, and it's always going to be buy side at every single high you see. Okay, and that's really important to understand. Again, another really good form of liquidity is look right here. See how we get a low here in the 1 minute time frame, and it perfectly to the cent, which is very rare. Look at this. The low of this candle is 18,503.25. The low of this candle is 18,503.25. It perfectly makes more equal lows. So what does the market do? It takes out those equal lows. It sees there's a bunch of stop losses underneath them, and we just wick it. We stop people out here. This is all their orders getting stopped, and smart money buys their orders getting stopped out, and then we go up. Okay, and you can just see how precise this is. Okay, this is not support. This is liquidity. And once you understand the concept of there's people stopping out here, and that's how the market reverses, you will totally just get away from the concept of, oh, this isn't liquidity, this is support, this is where people like to buy. That's not how the market works. I'm telling you, there's literally people trying to short here who, there's breakout traders shorting this because they go into the day and they're like, oh, I'm gonna short if we break below, and then let's say the level is 18,503.25. And they literally have these orders sitting here to short if this level breaks, because they think, oh, if this breaks, I'm going to short. And I know some people are like, oh, but they're going to wait for confirmation. Not everyone's going to do that, okay? And there's going to be a bunch of short orders here from breakout traders. There's going to be a bunch of short orders here from people who are getting stopped out. And it's all going to generate orders getting filled in the opposite direction, because for every seller, there must be a buyer, okay? So remember that. All right, so this is going to conclude this video for liquidity. I don't think there's anything else I need to go over really that should be included in part one. But everything I talk about, the rest of the bootcamp is all going to be in relation to where's liquidity, how do we find liquidity, and what tells us we're going to go to a lower high. So that's going to be it for this. Peace out.